Hello everyone, today we're going to discuss about the accounting concepts and accounting conventions. Now what are the accounting concepts? These are the various accounting concepts that we are going to study today. Accounting concept worked as the premises for the accounting, or we can say the procedure, the principles, or how we record in our books and how we practices the accounting in our books of the organization is dependent on the accounting concepts. Basically, we follow accounting concepts to provide the uniformity, to provide the feasibility, and to provide the universality. It means every organization that is performing the accounting in their books have to follow these concepts, which brings uniformity in their operations, which bring universality. You can compare accounting at anywhere, at any place, all over the country. Accounting concepts define the assumptions on which the financial statements of a business are based, that we are assuming while performing the accounting in our books. The very first concept we are going to discuss today is business entity concept. In my last lecture also I have told you this when we are discussing about the entity. The same is there. We are assuming that in the corporate organization, especially when we are working as a equity business firm or the firm who have taken equity from the society, that business and the business owner are the two separate identity, and they have the separate books of accounts and they are separately responsible for their profit and loss. That means if there is an owner Mr. A and there is a company of Mr. Owner A Limited, then the books of accounts of Mr. A and books of accounts of A Limited will be maintained separately, and they separately will be responsible for their profit and loss. And if Mr. A invests any amount in A Limited, that will be considered as the liability for the A Limited, and it will be shown on the liability side as the capital. And any amount if Mr. A withdraw from A Limited for their personal use, it will be considered as the drawing for A Limited, and it will be deducted from the amount of capital that is invested by the A. Because we are considering A Limited as a separate individual and A as a separate individual. Second concept. Second concept that we are going to discuss today is money measurement concept. Money measurement concept means only and only those transactions that can be converted into cash or involvement of cash is there, only that transaction we record in our books of accounts. That means, for example, there is any individuals, again we are taking A Limited only, and there was a person X who came to A Limited and said, I am placing you the order of rupees 10,000, but I am not paying you any amount. You prepare my order in 1 month. Now, because I didn't get any of amount from A Limited, nor I have started any of production, nor any of the amount have been indulged in my production, till then I get the confirmation for the order or my company decided to produce it. So, as I have not started to producing the product or I have not confirmed the product, not my company ordered the product, till then I will not record that type of transaction in my accounting books, and even accounting books are not responsible for any such type of transaction. If Mr. X confirm me the order and provide me some of the amount for that amount I will record in my accounting books. So, any transaction that can be converted into money and that have the financial aspect will be recorded in our accounting books. Otherwise, we don't record that particular transaction in our accounting books. Just it is giving, for example, sincerity, loyalty, these all we don't record in our accounting books because this didn't affect our profit and loss of the business organization. So, the transaction which is concerned with our profit and loss, in which our money have given or taken, only that we record in our accounting books. Third concept, that is going concern concept. In accounting, we considered as business as the going concern. Going concern means we didn't consider that business get ended after or few years. We considered business as a long run. We didn't consider its life, as we all are the individuals, and we consider our life as an ongoing. We plan our expenses, we plan our emergency bills, we plan our money accordingly. We didn't think that we have to go and this life get ended after so many years, so only for that I have to save my amount. No, we will make our savings, we make our emergency fund for the long term period of the time. In the same way, the business considered itself in our accounting books as a long concern. The basic difference that we get by assuming this is the assets that we show in our balance sheet, the liabilities that we show in our balance sheet, the expenses that we show in our balance sheet, all the money that we incurred in our business, that is for long term only also and for the short term also. As we consider business as the going concern, so we record the asset at their historical value and consider it as the asset because we didn't converting it into cash, but we can convert it as and when required. So this concept states that a business firm will continue to carry on activities for an indefinite period of time. Simply stated, it means that every business entity has a continuity of life. Thus, it will not be dissolved in the near future. This is an important assumption of accounting as it provides a basis for showing the value of assets in the balance sheet. Next, accounting period concept. Accounting period concept, like you and me have their birthdays. If I am of 36 now, next year I am of 37. Generally we compare, in 30s we have done this, in 32 we have done this, in 33 we are doing this, and in 35 I am doing this. We compared our life on the basis of these years. In the same way, the company have its accounting period. Accounting period means the period which is responsible for the profit and loss for that time. Like this is 2024. I am considering accounting period as January 2024 to December 2024. Or I can take accounting period as April 2024 to March 2025. Now, what's the procedure gets in accounting? Now, all the expenses and all the incomes that I incurred in this accounting period, whether January to December, if I have taken January to December, or April to March, if I have taken April to March, will be recorded in that accounting period only, and profit and loss of that period will be calculated in that accounting period only. From March, April 2025, next accounting period will be prepared. So, on accounting period, this opening stock, closing stock, outstanding expenses, prepaid expenses, this all get dependent. Because company is responsible for their accounting period, and it compares its financial position according to the accounting period only. It calculates its profit and loss according to the accounting period. It plans its strategies according to the accounting periods. It makes its plan for the next according to the accounting period. So, accounting period basically can be said as the particular timeline, a particular timeline defined by the organization for which it makes its particular strategies or for which it prepare its profit and loss account. So, all the transactions that are recorded in the books of account on the assumption that profit on this transaction are to be ascertained for the specified period, and this specified period is known as the accounting period concept. Thus, this concept requires that the balance sheet and the profit and loss account should be prepared at the regular intervals. This is for different, it is very important for the purpose of ascertaining of tax, for ascertaining the financial position, for calculation of the profit, because we compare ourselves on the basis of these accounting periods only. Next, accounting cost concepts. Under accounting concept means all the assets that we record in our balance sheet will be recorded on the basis of their historical cost, means on the cost on which you have acquired that particular asset. You didn't record the value on the basis of market value. For example, there is A Limited only, and A Limited have its machinery, have its building, have its land, which he purchased at the cost of rupees 1 lakh, 2 lakh, 5 lakh or any amount. According to the time, market value gets changed. It can be increased, it can be decreased. But in my books, it will be shown at the value of at which I have purchased this particular assets. If some of the amount I have added in construction or building anything, that amount I get added on particular asset. But the amount I will show at the historical value only. The only that I deduct from this historical cost is depreciation. That will be charged according to the years. Accounting concept state that all assets are recorded in the books of account at their purchase price, which includes cost of acquisition, transportation and installation, and not at its market price. It means that fixed assets like building, plant and machinery, furniture are recorded in the books of account at the price that we paid for them, not at the market price. If your building value gets, you have purchased for rupees 1 lakh and now it's become of 1 crore, you didn't record it in your books of accounts at rupees 1 crore. In your books, it will still going at rupees 1 lakh. Next, dual aspect concept. In accounting, we says it is assumed that every transaction have a dual aspect. Dual aspect means it is the very first base of recording the transactions in the accounting books. Dual aspect says assets equals to liabilities plus capital. For every debit, there is a credit. That means if you are giving something, you are getting something also. Nothing transaction is one-sided. All the transactions have the dual aspect. Dual aspect concept also facilitate us in recording the transaction in our accounting books. In our accounting books, we record the transaction in both the aspect debit and credit also. Accounting says, for example, you have purchased the furniture. If you purchase the furniture, you will give the cash also, or you purchase it at the debt, so you burn the liability. So there is a dual aspect. I have purchased the furniture. Furniture is my asset. Furniture is at my home. But for purchasing the furniture, I have paid the amount. So cash is also my asset. It also gone from my side. If I have not given the cash, I have taken it at debt, then it becomes my liability. So if one asset have come to me, one liability also obliged on me. So dual aspect began. Another example we can take. I want the stock of raw material in my company. I got the stock of raw material in my company, but I have to pay cash for that. If I am not paying right now, so I have to own the liability for that. So the purchasing of raw material become my asset, but for that I have to make liability. So assets become equal to liability. In the same way, you sold your goods. Goods gone from your side, you sold to any other individuals, but in return you will get the cash. Maybe you get the cash this time or after some time. If you are getting cash this time, then very good. Your asset get increased. One asset gone and another asset came to you. Asset gone, stock, and asset came to me is cash. But what if I didn't get the cash this time, that means that another asset became, that is my debtors. So every transaction that I am discussing, you can take any transaction. For example, you are paying for the salary, you are paying for the rent, you are paying for the telephone. Now these are the expenses. You are incurring the expenses, but means you are taking the benefit of these all. But these benefits are not free. You are paying for cash for that. So accounting says nothing is for free. Nothing is a single aspect. Not only one individual is involved in any transaction. Transaction have the dual aspect. It is between the two parties. It is between the two individuals, two separate identities. So both the aspect have to be recorded in the accounting books. But it should be from the organization side only. That one thing that you all have to consider while preparing the accounting books and accounting concepts, that the overall transactions that we record in our accounting books should be from the side of the person whose accounts you are making. Means if I am making the accounts of A Limited, then all the transactions will be seen from the point of view of A Limited only. So the dual aspect also I am seeing from the point of view of the A Limited only. That A Limited have purchased the furniture and A Limited have given the cash. A Limited have sell the stock and A Limited will receive the cash. So all the aspect we are considering or we are viewing from the point of view of A Limited, and that is basically the dual aspect concept. Dual aspect means assets equals to liabilities or plus capital, means the asset that the company have will purchased from the money, and that money will have been invested by the owner or any other individual. The company who have arranged the amount from the owner or any other individual will be considered as the liability for the company. Therefore, assets are always equals to the liability plus capital. Matching concept. This concept is also very much important and always should be remembered by the students while performing their accounting operations. Generally, students get confused in this, they just record the transactions in their accounting books. They didn't see the dates, they didn't see the procedure, and they didn't see the transactions are of which companies or which particular product or what is the relation of that expenses. Because in our accounting, this concept says that the revenue and the expenses incurred to earn the revenue must belong to the same accounting period. That means when we have talked, and I have talked about the accounting period, that we considered accounting as in for the indefinite period, but divide the life of the company into a particular accounting period, and that accounting period is only responsible for its profit and loss. Now, if it is going January 2024 to December 2024, so the revenue that I have incurred in this particular duration, my all expenses and income should be matched by that revenue only. Means the expenses that I have done to earn the revenue that I have incurred in this accounting period will be recorded in particular that accounting period only, not of last or the further accounting period. That means, for example, I have taken any building for the rent and it is December. I am making the account from January to December. Now, last December 23, there is any rent that get due or that I have not paid, that is not matching with the revenue, or there were some expenses that I have incurred in the previous year which is not concerned, or that stock not sold in this year, that all the stock gets closing. So, the expenses of particular that stock will not be recorded in my accounting books, will not be shown in this particular year. Only the stock from which you have generated the revenue, those expenses will be shown in our accounting books. That should be matched with our revenue, only then we can calculate the profit. Because matching concepts realize if the revenue is more than the expenses, it is called profit. If the expenses are more than the revenue, it is called loss. This is what exactly has been done by applying the matching concept. Because if you record any other expense, any other income other than the revenue that you have earned, then it gets mismatched and you can't able to identify what profit we have earned in particular accounting period and what we have the stock. So therefore, this matching concept has the various importance. Realization concept. This is somewhat similar to the matching concept only, but slightly different. In matching concept, we have studied that your expenses and revenue should be matched with each other. But in realization concept, it is considered that you record the transaction in the books or you record the amount of revenue in the books only and when then particularly you realized it in. Until and unless the amount gets in your hand, you can't be said or can't record it in our accounting books. This concept states that revenue from any business transaction should be included in the accounting records only when it is realized. The term realization means creation of legal right to receive money. Means you can't record it until and unless you get realized. That doesn't mean that you received it in cash only. For example, there is X Limited, you sold some goods to X Limited. He purchased from you, he taken it to their company. So, he purchased from you, he given you the consent that he have purchased your order get dispatched from your company, means that order get dispatched, reach to the X Limited get owned that yes, I am taking this order, I am not paying the cash amount for that, I am obliged and I will provide you the payment after particular time period. So, at the time, he will pay the amount after 3 months, but that sale should be shown in my books of accounts at today only, because I am making the sale today. Amount I am getting 3 months after, but sale I am making today. So, that sale will be shown in my accounting books on that day only, on the day on which you have realized that your sale has been incurred and your payment get due. If you are getting the cash, then obviously you will record it on the same day only. But if you are not, if you are getting the cash also, then also you will record your sale on that day only. You record it as the due sale, or you can record it as the debtors that you will get the amount after 3 months, or you can say it as a credit sale. Accrual concept. Accrual concept means when you get your amount due, then only you record in your accounting books, unless and unless you get the payment or not. For example, I am in this accounting period of January to December 2024. Now in December 24, I have to pay the rent. But due to some problem, I can't able to pay the rent and I paid it on January. Now in December, accounting books got closed, but my rent is due. So that will be recorded in that accounting period only, because my expense get due and it have to be recorded in that period only. Accrual concept says, as the realization concept, the amount due at this which time only that time you will record that in your books of account or in that particular accounting period only. That is an accrual concept. You get the payment or not, that is another case. But amount you have due, so you will record it in your books. So these are the various accounting concepts that we studied today. Next we talk about the conventions of accounting. Now, question arises, what is the difference between the concept and conventions, and what new we are going to study under accounting conventions? Accounting concepts are the assumptions that are the base on which accounting is based, and that are also universal and should be followed while performing the accounting, or we assumed while checking the profit and loss or ascertaining the financial position that have been done by the company. These accounting conventions are the practices. These are not a law, but they are the certain practices or they are the certain principles that should be followed by the company while performing the accounting operations. Means these are not legal, these are not binded by the law, but it is mandatory or it is sincerity of the company to follow these particular conventions to make the accounting more transparent, more reliable and more visible to the particular individuals whoever are using the accounting. Because accounting plays a very important role for all the users who are working in the company or who are related to the company. There are the various users and there are the various individuals who required the accounting. We can say the company owner needs the accounting books, government needs the accounting books, employees needs the accounting books, investors need the accounting books, Particular customers needs the accounting books, society needs the accounting books. There are the various individuals, whoever are connected to the company in one or so waiver, suppliers, debtors, creditors, they all need the financial position of the business organization. They are all concerned about the profit and loss of the business organization because their investment have been made in the company. They are related to the company. Their livings or their earnings are depending on the company. So they want to know the profit and loss of the company at every aspect. Therefore, it is very important that accounting books should disclose the information that is very much transparent and very much reliable, because it is an important information on which person's living is dependent, person's decisions are dependent. Therefore, there are certain conventions which worked as a guide while preparing the accounting books or accounting statements to make it more convenient. First, accounting convention that we are going to discuss, it is a convention of consistency. Consistency means to be regular. Same is there in accounting also. In accounting, we have the various practices and the various procedures that can be used to prepare the financial statements. For example, there is one concept that is known as the depreciation. What is the depreciation? I have told in my previous lecture, but I am explaining you again. Depreciation means decrease in the value of the fixed asset. We considered that the fixed asset value get decreased from year to year because of the time span. And the decrease in the value is known as the depreciation. Now, company have the various method to charge the depreciation. In our accounting books, there are n number of methods that how this depreciation can be calculated and can be used in our accounting procedures and practices. And it dependent on the company that which particular method is chosen or which particular method is convenient to him to calculate the depreciation. But company can choose any method which is convenient to the company. There is no foundation on the company. But that method used by the company should be consistent. That means the company should not practice it that 1 or 2 year he use one method of the depreciation and another year the company use another method of depreciation. Means the amount of depreciation that is charged by the company or amount of depreciation, the formula that is the company using for charging depreciation should be consistent over the years. This particular convention is important because to ascertain or to compare the financial position over the various year. Because if company changes year to year its depreciation procedure or any practices changes year to year, so it becomes very difficult to the users and to the owners to compare the financial position or to know the financial position of the company, or it's somewhat they get confused in ascertaining the profit and loss of the business enterprise. As I have told you that it is very important for the users to know the company real position. So convention of consistency only this says the practices or the procedures that is following by the company to prepare its financial statements can be any, which is defined in the accounting statements or accounting books or accounting legal framework. But that should be consistent so that owners and the users who require the accounting, they know that at what parameters they have to study the company financial position. Convention of full disclosure. This is also very much important. In the previous, we have studied in concepts that revenue concept we have studied, realization concept we have studied, accrual concept we have studied, that the amount of transaction should be recorded at the time only that have been realized. You will not wait that when you are getting the cash, when you get the cash, you record it in on the books that you have received cash today. Full disclosure means company should show its each and every information in the accounting books to be transparent and to be reliable by the users of the accounting. Users of accounting should know each and every information related to the company in the books of accounts. Require all the material relevant facts concerning financial statements should be fully disclosed. There should be full, fair and adequate disclosure of accounting information, sufficient set of information to be disclosed, equitable treatment of users should be there, and detailed presentation of information should be there. Should fully disclose all relevant information that is required by the users of the company. Users required every information related to profit and loss, related to expenses and revenue, related to other incomes that was incurring in the company, related to capital and drawings, related to dividend, related to share value. They required each and every information. So they should get from the accounting books each and every information that is related to them. The business provide financial information to all the interested parties like investors, lenders, creditors, shareholders. Shareholders like to know the profitability of the firm because shareholders' fund have been invested in the company, and if the company true financial position is not there, then they were not able to know that whether they continue with their investments or they have to withdraw their investments. Creditors, they want to know the solvency of the business because they have a debtor, they have given the sum of the amount or their amount as the debt to the company, and they want to know whether the company should be able to give back their fund or not. Means because they have given their raw material or their supplies at no cash payments. So they want their payment as early as possible. So they want to know the position of the company so that they can be assured that they will get their money back or not. Same other parties, there was several parties who were attached to the companies who were concerned about the profit and loss, like employees. They want to know the profit and loss and they want to know all the information about the companies as they are getting the salary from that company and their future decision whether to continue with the company or not, whether to continue with the same company dependent on the accounting information that ascertained from the accounting books. Owner also continue with the same business, to diversify the business, to expand the business or to do another parameters of business, another strategies to develop the business, also dependent on the accounting books. Lenders, whoever have given the amount of money to the company for any purpose, for any liability, that person, banks also who have provided the money to the company as the liability, they all are concerned about the accounting books because they want to know the real financial position as their money is involved, and they all want to assure that their funds are safe with the company or not, whether they get the good return or their money back or not. So this full disclosure concepts have the various importance in the accounting books, and it dependent their whether, and it is a right of every individual who are connected with the company to know the each and every information of the company that is related to the accounting. Convention of materiality. This is somewhat contradictory to the full disclosure. As full disclosure concept says that each and every information should be fully disclosed as it is required by the accounting users. But this concept says that in our accounting books, if only the financial statements or only the financial transactions that have the material relations or have the material fact related to our financial books should be recorded in the accounting. That doesn't mean that the company didn't give the full disclosure. This principle relatively applies there also. Yes, full disclosure should be there, but material facts should not be ignored and should be considered more importantly. For example, I have paid some of the minimum amount for the stationery or for tea, coffee or anything, and I don't have the bill or voucher for that. As I have told you, voucher is very much important to record the transaction in our accounting books. But amount is so much minimal that it doesn't affect the transactions of the accounting. or it doesn't affect any financial statement, or it doesn't get more of the effect on the profit and loss of the business organization. And if the companies forgot or didn't record it or recorded in some other amount, then it will not be considered, or it can be shown by the company. Means some of the miscellaneous expenses whose company vouchers are not there, it is on very minimal amount that is not making more of the impact on the profit and loss of the business, then it should be recorded in the business organization. Convention of materiality state that to make financial statement meaningful, only material fact that is important and relevant information should be supplied to the users of accounting information. The question that arises here is what is a material fact? Materiality of the fact depends on its nature and the amount involved. Material fact means the information of which will influence the decision of its user. As accounting is for the users, they require the material information. They were the basic information that is required by them. So your accounting book should give importance firstly to that material fact that is very much important from the point of view of the accounting users. If there is some of information that is not important for them and doesn't make any impact on them, if you are not showing or you are not disclosing that, it is totally permissible under accounting books. Convention of conservatism. Conservatism, as the word applied, be conservative. Conservative means be inner. We don't want to disclose various things. Accounting says be conservative. Be conservative means don't anticipate your profit, what you are going to earn in the future. Don't anticipate it, previously only. For example, my sale is going very good. I am anticipating that by the end of this year, I will make the profit of 5 lakh rupees. But that 5 lakh rupees is not earned by me. Accounting says don't show it in our books because you have not realized that profit. Only you are anticipating that profit. So it can't be shown in our accounting books. We can't make any plan, or we can't do any expense, or can't show any expense according to the our assumptions that we will get the 5 lakh rupees in our end of the accounting books and we will show our expenses according to it only. No, till or then that profit have been realized. But you can anticipate your losses. Accounting says don't anticipate the profit. Don't assume what you will get. But you can anticipate your losses, and you can prepare yourself for that losses. Now, how the company prepare itself for the losses? If there is an accounting anticipate for loss, for example, I am anticipating that some of the debtors will not give me my payment back. If my debtors amount is rupees 10 lakh, and I am assuming that near about 10% of the debtors will be bad debts, will not provide my payment because of their accounting reports or because of their any financial information that is floating in the market. I am assuming that this will get bankrupt or this will get insolvent. Now, if at the end, or because the debtors are of previous year, I am carry forward that amount into this year, and I am found that in this year also this particular debtors will not give me my payment. Now, what will happen? My debtors amount get decreased, and so my profit get decreased for that year, because on that year only I didn't get my payment. But that year says that this payment is not due of I am making my profit, but you are deducting my amount of debtors, my assets. You are deducting because you will not get the payment. Now, why I am responsible for this? Why you are deducting my profit? That accounting period, because all the accounting periods are responsible separately for their profit and loss. Now, what can I do? What is the answer for that? So, what is the procedure for this? Company will make one provision for bad debts, and that provision will be made from the profit only. Every year, from the starting or from any time, he started to making some provision. That is provision of 10% on debtors. Means every year he deducts some of the amount of the profit and kept it separately under the head of provision, under the name of provision for bad debts. And it will shown on the liability side only, because that is the profit, and profit is of the company, and because the company have not any amount of its own, that amount is of owner only. So the amount that is invested by owner is the liability for the company. Therefore, that profit is also belongs to the owner of the companies. So because we are making that provision from that profit only, that provision is also considered as a liability for the business. So if any loss I incurred in any year from the debtors, that amount get deducted or amount I am get from that provision. It is like the emergency fund that you make in your homes for any safety purpose. In the same way, this provision works on. Not only for the bad debts, there were the other also emergencies, also problems that can be incurred by the company. For that, the company make the provisions. For example, this depreciation. This depreciation is also for the anticipation of the losses. For example, I purchase any machinery for rupees 1 lakh, and that machinery will work for the 10 years. And I know after 10 years, I have to purchase another machinery. But because that expense I have to incur after 10 years, and I don't know after 10 years, if I spend so much of amount, then in that year, my profit gets decreased. So I can't burden that year for that for so much of amount, because I have used that machinery for all of the 10 years. So why that year only bear the amount of that machinery? So what I am doing? Every year I am deducting the amount of depreciation from the profit to that amount I am accumulating somewhere in the head of the depreciation, so that when after the 10 year, my machinery become obsolete and I have to purchase the new machinery, I already have the amount of that machinery under the head of depreciation. So that year will not get burdened, that this machinery will be purchased from that accounting period. That machinery will be purchased from that provision only. So these provisions are for the anticipation of any expense or any losses that we are anticipating in the near future, that we are going to held in the near future, but we are preparing it for today. It can be for taxation purpose, it can be for depreciation purpose, it can be for bad debts purpose, it can be for any other liability that or any other loss that we are going to incur in the near future. So it is like the emergency funds that we make in our homes, that provide us the facility, like we make for the children's safety, children's educations, and whenever this particular amount get due or required, we take out the money from particular head and give it to our children and give it to our family members, so that they can make the expense and we didn't get overburdened in particular time period, because that operations of that particular period goes on smoothly. So this is the concept of conservatives. So very, very important convention, that don't anticipate the profit, means don't make any plan according to what you are anticipating about the profit. Till then you get incurred your profit. But you can anticipate your losses, you can prepare for your losses, you can still make some provisions from the losses, so that your business operations can work smoothly, your accounting books didn't get overburdened on any specific accounting period. The main objective of this convention is to show minimum profit. Profit should not be overstated. If profit show more than the actual, it may lead to distribution of dividend out of capital, and which will not be fair and will result to reduction in the capital of the enterprise. Thank you. This is all about the accounting concepts and conventions, and I found it that you really found it very useful, that how accounting concepts works and how accounting conventions work.